In 2014, journalist Michael Lewis published Flash Boys, revealing that the U.S. stock market was systematically rigged in favor of high-frequency traders. But what the book described was only the visible part of a deeper shift. By 2013, 40% of all equity trades in the United States never touched the New York Stock Exchange or NASDAQ. They happened in private trading venues called dark pools, operated by the same banks that were supposed to be competing in the public market. And the public had no idea.
Dark pools were created legally in 1979 when the SEC allowed large institutions to trade large blocks of shares off exchange to avoid moving the market. The original logic was sound. If a pension fund needs to sell 1 million shares, putting that order in the public market immediately moves the price against the seller. A dark pool allows large transactions to be matched privately. This is the legitimate use case. What dark pools became is something different.
By 2010, there were more than 40 dark pools operating in the U.S., run by Goldman Sachs, Morgan Stanley, Credit Suisse, Barclays, and others. These venues were supposed to provide best execution for their clients, the best available price. SEC investigations found that multiple dark pools were routing clients' orders in ways that benefited the banks themselves, or providing preferential access to high-frequency trading firms that were front-running the very orders being placed.
The Barclays case became the most documented. In 2014, the New York Attorney General sued Barclays for fraud in its dark pool, Barclays LX. The lawsuit alleged Barclays had falsified marketing materials claiming its dark pool was protected from predatory high-frequency trading, while simultaneously giving those same firms preferential access and routing client orders directly to them. Barclays settled for $70 million in 2016. No executives were criminally charged.
The systemic problem is informational. In a public market, all trades are reported in real time. Prices are transparent. Dark pool trades are reported with a delay or not at all. Large institutional investors can trade at prices that retail investors never see, using information about order flow that isn't publicly available. The result is a two-tier market, institutions with information advantages and ordinary investors without them. The tiers are not equal.
After the 2014 revelations, the SEC enacted new regulations and increased reporting requirements. Dark pool market share declined from approximately 40% to 35%, then stabilized. Dark pools remain legal, profitable, and heavily used by the same institutions that were caught abusing them. The SEC collected several $100 million in fines. No dark pool was shut down. The revolving door between the SEC and the financial industry, where regulators become bank executives, remains well-oiled.
Dark pools are not a malfunction of the market. They are a feature created by regulation, operated by the most powerful institutions in finance, and generating billions annually in fees for those institutions. The public sees the NYSE ticker. The actual trading happens somewhere else, in venues the public doesn't know exist, under rules the public doesn't know apply. This is not a conspiracy. It's the published market structure. Subscribe.